What if you can put money into business property without doing anything? Imagine a method that is so easy to use that it almost feels like cheating, but it can bring in a lot of money. How does this simple method work, and why might it be the best way for you to invest? Stay with us until the end to find out the easiest way to get into business real estate and start making money right away. Rental homes. When it comes to new investors, this choice is perfect, particularly if you have previous experience as a homeowner. The process of getting started is not all that unlike to the process of purchasing a property. And if you are relocating, you can even rent out your previous residence rather than selling it. Due to the fact that you already own the property, this is an excellent method for making the shift. Whatever path you choose, be sure you don't forget to do the math. An excessive reliance on appreciation, carried out without an appropriate evaluation of cash flow, is one of the rookie blunders that we observe. Instead, think of your monthly cash flow as the cake and appreciation as the icing on top of the cake. When you do this, you will not be caught off guard by poor performance. Commercial leasing. Commercial real estate is probably the asset kind that is most comparable to residential real estate. Although the procedure of buying and renting is identical, the difference is that you rent to businesses rather than individuals. Retail shops, warehouses, and office buildings are examples of frequent types of commercial renters. Diversifying your real estate portfolio is essential since commercial investing is characterized by greater initial costs and a volatile market. Since of this, it is essential to diversify your portfolio. In some cases, commercial properties may remain vacant for a considerable amount of time until a suitable tenant is found. At other times, an area that was formerly considered hot can become chilly in a matter of weeks. However, investors with a moderate to high level of experience will receive the highest results from this sort of investment. This type of investment may not be suited for a first property. Loans for commercial bridges. Perhaps you are acquainted with residential bridge loans, which are short-term financing instruments that enable homeowners who are in the process of purchasing their next house to temporarily access the equity in their current home until they are able to sell it. It is possible for a property to develop an income history, be renovated, or be rehabilitated with the assistance of temporary finance. Commercial properties are very similar to residential properties. You're officially considered a private lender because you are the investment. The ability to put some of your lazy assets to work and generate large profits is made possible through collaboration with other lenders. Constructions of apartments. The gold standard is what you should remember. When compared to single-family homes, apartment buildings offer the ability to provide accommodation while in addition generating a larger return on investment. A building that is well managed and located in a desirable region might provide you with a steady income that is in the double digits. Additionally, there are certain favorable tax advantages as well as the possibility of appreciation in the future. It is not a game that is suitable for beginners, which is a drawback. Generally speaking, the initial investment is greater than that of a home rental, and if you do not have the appropriate management knowledge or assistance, it may be a nightmare. There are certain responsibilities that fall on your shoulders as a landlord, and the number of renters you have simply serves to expand those responsibilities. Having a team at your side might be beneficial in this situation, particularly if you are searching for a lazy way to invest in real estate. Investments in equities. The majority of the time, in order to invest in equities, you are required to be an accredited investor. This implies that you must either have a net worth of $1 million, excluding your principal property, or have an annual income of $200,000 for the past 2 years. If you are married, you pay $300,000. This is not an option for those who are just starting out. Nonetheless, having a portfolio that is diverse helps point you in the correct direction. You can invest passively through equity investing, which eliminates the need to search for, buy, renovate, or maintain properties. Additionally, equity investment provides you with a fractional portion of the equity in the property. Flipping one's house. It is likely that you are familiar with the concept of house flipping if you have watched HGTV. However, despite the fact that it is fairly labor-intensive, they make it out to be simple and enjoyable. You need to take into account the amount of time and effort that you put in if you are doing the work yourself. In addition, if you are not inclined to be a handyman, it may be expensive to hire a contractor who's fit for the job. Because the market can swiftly go in the opposite direction, and because renovations take a lot of time, this kind of investment includes a significant amount of risk. Then there is the unpleasant fact that one must face with reality show math. There are several instances in which television shows fail to incorporate fees such as interest, loans, or closing costs. If the concept of remodeling is something that piques your interest, you might want to think about purchasing a property that needs some work and renting it out to yourself. In addition to being able to recuperate the cost of the mortgage, you will most likely be able to charge more for the upgrades. Compared to the situation in which you just sold the house, you will have a superior cash flow in the long run. Homes that are lease-to-own. The lease-to-own model has the potential to be a profitable business strategy in markets where housing prices are low. In the event that investors are willing to discover how to perform it effectively, it provides a number of distinct benefits. Strategies that combine short-term and long-term profitability are known as lease-to-own. Additionally, the landlord's responsibilities are reduced due to the fact that the tenants are prospective homeowners who are prepared to treat the property as if it were their own apartment. It is in their best interest to take up the obligations and activities associated with maintenance. This may have long-term benefits for investors who would want to have a decreased obligation as a landlord, despite the fact that it may have an initial learning curve. REITs. It is because of the simplicity of investing that real estate investment trusts have become so popular. Most of the time, they operate in a manner similar to that of a mutual fund or a private equity fund, and they are significantly less hands-on. REITs are a good option to consider if you are seeking for a strategy to invest in real estate that is less time-consuming. However, it is essential to take into consideration the drawbacks. Just like mutual funds, real estate investment trusts, REITs, and have a negative performance when the economy is in a downturn. During the year 2008, the value of commercial property REITs fell by 49%, while the value of mortgage REITs fell by 42%. Despite the fact that real estate investment trusts, REITs, are among the most lazy ways to invest in real estate, the risks associated with them are significantly higher than those associated with the majority of other options. Land. In spite of the fact that property is a highly hands-off investment, it does not normally provide cash flow unless it is leased. The most prevalent types of land leases are for purposes such as oil and gas exploration, farms, and campgrounds. The absence of a lease agreement makes it a highly speculative investment, and investors frequently purchase in the expectation that values will go higher in the future. The property taxes are being paid by them in the meantime. The use of land leases rather than raw land is something that we advocate in order to reduce speculation and boost cash flow. Renting on a part-time basis. This is the year 2020, and you have most likely heard of or utilized Airbnb or VRBO. Additionally, if you have utilized them, it is likely that you enjoy traveling. Have you noticed where we are headed with this? If you reside in a location that has some appeal to tourists, you might want to think about renting it out through Airbnb when you are gone. You never know what will bring people to your location, even if you are not located in a region that is heaving with tourists. Increasing your income flow, successfully paying off your mortgage, or even funding your own vacations are all possible outcomes that can be achieved using this method. And for those who are concerned, there are a lot of different ways to safeguard your precious belongings. Furthermore, you have the option of purchasing a second home or apartment in a popular location and renting it out through one of these companies. There is a great deal of untapped potential for both self-management and management that is contracted out. When you consider that renters are paying by the night, you have the opportunity to generate more money than you would if you were to get rent on a monthly basis. Be sure to verify the restrictions that Airbnb has placed on your region. Some communities are restricting possibilities in order to prevent themselves from running out of local accommodation. Ready to discover the easiest way to invest in commercial real estate? Subscribe now and learn how to make your money work for you with minimal effort.